So if you've had multiple jobs over the years and end up with multiple pension pots, it's usually a good idea to combine all those pension pots into one pension. But before you go ahead and do it, there's some key information you need to find out from all your existing pension providers. Some older pension schemes have some very valuable benefits that you can't get with today's modern pensions. And if you were to transfer these old pensions, some of these valuable benefits could be lost. So in this video, I'm going to run through why it is a good idea to combine your pension pots and the 6 things you need to check with your existing pension providers before you decide to do it. My name's Carl Roberts. I'm a chartered regulated financial advisor. So why is it a good idea to combine lots of different pension pots into one single pension pot? Well, to start with, it's going to be much easier to keep track of all your pensions if they're in one pot. If you've got lots of little pension pots, every time you move or change jobs, you're going to need to update those pension scheme providers with your latest address and things. And there's a whole load of wealth lost in pensions that is sat there because people don't know they've got pensions they need to claim on and they've moved over the years. So having one single pot is going to be far easier to keep on top of, and also far easier for your loved ones, your family members, because if something happens to you, it's again much easier for your family to work out what pensions you have if they're all in one pot, rather than going off and trying to find lots of different pots with different providers. Combining your pensions into one is also going to make it feel like you've got much more in retirement savings. So we meet a lot of clients that have lots of smaller pots with different providers and they don't think they have that much in pensions. They don't think pensions are worth it. But when you start to add all of the smaller pots together and create that larger amount, it puts things into perspective. It actually feels and looks like you've got more in the pension if you combine them all into one big amount. And then it gives you focus in terms of understanding what more you need to invest and contribute to pensions to hit your retirement number. A larger pension fund, rather than smaller ones, is likely to have much less charges than the smaller ones because there's an economies of scale at work here. Usually pension companies operate a tiered charging structure where the percentage charges start to come down the more money is invested. So lots of smaller pots will tend to be at the highest rate of charge, whereas a bigger pot will tend to have lower charges overall. Also, if all your pensions are in one pot, it's then far easier to manage the underlying investment strategy rather than having to make lots of different investment changes to lots of different pensions. How do you keep track on all of this? And are you aware of what your overall portfolio looks like in terms of a risk profile, allocation to kind of stock markets versus bonds and cash? If you've got it all in one pot, it's far easier to manage the investment strategy. And finally, another big one is going to be accessing flexible retirement income features. Now, most older schemes don't allow you to take income from your pension when you retire in lots of flexible different ways. They have limited options. Whereas the new modern day pensions offer far more flexible features when it comes to pension drawdown and requiring pension income. So it sounds like it's generally a good idea to combine all your smaller pensions into one pot. But of course you need to be clear what you're giving up. Like I said earlier, there's certain things you need to check with your existing pension providers to make sure you're not giving up any valuable guarantees and benefits. So let's run through these. The first thing you need to be aware of is what is the type of pension you're looking to transfer. Okay, there's mainly 2 types of pension: a defined contribution pension, which is your sort of workplace personal pension where you pay in, your employer pays in, and you've got a pot there. There's a value to it. You can go online and check how much is in the pot. The other type of pension is your defined benefit pension, also known as a final salary pension. Now, there's no pot value to this as such. It's just a promise of a secure income when you hit retirement. Now, these are 2 very different pensions. So if you're planning to transfer a defined contribution pension into one pot, then there's not so many risks attached to that. It's fairly simple. It's the same type of pension going into a different type of pension feature but still a defined contribution pension. But if you're looking to transfer a defined benefit pension into a pot, that's a whole different ball game. Now, the Financial Conduct Authority, the regulator, has insisted that if you want to transfer a defined benefit pension and it has benefits over £30,000, then you must seek regulated financial advice. It's a whole different type of pension, and your circumstances need to be clear as to why you're looking to transfer that type of secure income for a more flexible pot. So yeah, be really clear on what the type of pension is you're looking to transfer before you do anything first. Okay, the second thing you need to check with your existing pension providers is whether they apply a transfer penalty. Okay, so this can sometimes be easy to miss because when you look online or you get a statement that shows your current pension value, the transfer penalty is not usually reflected in this. You need to request a transfer value as well as the current value, as the transfer value should reflect any penalties due on transfer. Now, some providers might not even call this a penalty. They might apply an administration charge for arranging the transfer to another pension provider. You need to be really clear what this penalty is and weigh up whether it's worth still transferring and taking the hit. Is the penalty or the fee so detrimental to the overall value that it's just not worth transferring at this stage? Now, most of the time, penalties tend to run out or reduce over time. So once you've held your pension long enough with an existing provider, they might reduce the fee significantly or wipe it out altogether. So if you do have a fee, find out from the existing provider, when does that fee run out, or what stage does it reduce over time? Okay, next, you need to find out from your existing pension providers whether any of them have some form of guaranteed income. So we're not talking about a defined benefit pension here. We are talking about a defined contribution pension. But some older style defined contribution pensions do offer some form of guaranteed income at retirement. So it's usually either called a guaranteed minimum pension or a guaranteed annuity rate. Now, the rates of income that these older pension providers offer tend to be higher than what's available on the open market. So if you're looking for a secure income in retirement, then this could be a valuable feature for you. Now, I'm not saying if your pension has one of these that it's definitely not worth transferring. You just need to be clear on what the benefit is and does that suit your objectives and goals for your retirement planning. Now, another thing to check is that in the same way that some older style pensions give you a guaranteed income in retirement, some also give you a guaranteed pension value at a certain point in time, or a guaranteed level of return. Particularly if you've got pensions that hold what's called with profits. So these were quite popular back in the day. And some of these types of pension schemes do have a certain return that they have to give clients. So these types of pensions, although they're invested, rather than you getting investment returns that kind of go up and down like the stock markets, you actually get the return in the form of bonuses. And sometimes some old pension providers have to guarantee these bonuses. So you need to look to see whether the guaranteed bonus rate you're getting is that better than what you could get have you invested your funds in the global stock markets. Also, the same with the guaranteed minimum pension value. At certain points in time, old pension providers have to guarantee the value that's in your pension pot. Again, this might be valuable, it might not be, because you might not want to retire at that point in time. You might still believe you can get a better rate of return if you invest in the global stock markets. So just something to check. And again, you need to weigh up whether it's valuable to you. Now, most people nowadays, particularly with modern pensions, understand that you can take up to 25% of your pension pot tax-free as a lump sum. Some older schemes have the ability to protect a higher amount of tax-free cash. So it could be higher than 25%. So again, you need to find this out and weigh it up. If you're someone that is looking to take a lump sum out of their pension on retirement, perhaps an older pension with a value that's higher than 25% could be quite valuable to you. So yeah, check to see if your old pension has a protected tax-free cash lump sum, and is that higher than today's 25% standard rate? Okay, the final thing to check on this list is life insurance. Now you may be thinking, I thought we was talking about pensions, why is he going on about life insurance? But some older pension schemes not only cover your pension, they also pay out an additional life insurance amount on top. So if you were to pass away, not only would your family be able to inherit the pension pot, they would also get an additional life insurance payout on top of that. So you need to look at, if the existing pension provider offers this, what's the amount? Is it significant? Is it really valuable? What's your health like at the moment? Is it something that you feel actually your family might need to claim on, in the near future? So again, it's not to say that you keep it definitely if it has life cover, but it could be useful for you depending on your circumstances, particularly if you've still got mortgage, you might have your kids in schools and things. Perhaps some extra life cover could be useful, but you'd have to weigh that up in terms of, well, what does the overall pension look like as well, and could you get some additional life cover cheaply on the open market anyway? So to summarize, yes, generally a good idea to combine lots of pension pots into one, but you need to go through the list of features that we've just run through and check that you're not going to be giving up any of these valuable benefits, or if you are, that you're clear why you are and that you feel that there's greater benefits from having a newer combined pension pot. This is the sort of work we do day in, day out with our clients, particularly when we get new clients and we have to assess all their pensions. We will run through a list like this to make sure that no valuable benefits are given up without the client understanding and getting something better with a new pension. So yeah, just if you have any of these features that we just run through, it doesn't mean don't transfer. Just be clear on what you're giving up and what you're getting in return if you do decide to combine your pension pots. I hope you found this video useful. Please don't forget to subscribe to the channel because there's many more videos coming in terms of retirement planning, investment strategies and all that good stuff. Until next time, take care.